Hi, I'm Mark Crisano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to go through, what does the data mean? What does it say? What do we think going forward? And we're going to break that up into our normal, the brief overview of pretty much, everything, the summary. Then we're going to go deeper into refined products within the U.S. and then take that to the next level in the last segment, looking at U.S. exports and what do we expect to happen in the global market. So one of the things that we've liked to start to do is to provide a brief overview of what do the numbers look like, what do they mean. So realistically, based on especially when you factor in last week, they're very normal. These numbers were very seasonally normal. There wasn't all that much to say that there was something that was bullish or bearish. It was mostly neutral. And the reason why we say that is because when you look at at crude oil builds and draws, the draw was really driven by PADD 5, which is just the West Coast, with a lot of the others being fairly flat. Then when you look at gasoline on a seasonally adjusted basis, this is the third highest ever on storage. And we still have yet to really break to where we normally are on the gasoline demand side. Then on the distillate side, things remain strong. That remains robust. Jet fuel, on the other hand, another build occurred. There was some shift in demand with PADD 5 seeing some additional demand, but as we keep saying, a lot of these are just going to be that chevron pattern of up one week, down another, and we're just not seeing a lot of growth to climb back to where we are, and we're already into the end of July. So that's going to be a matter of where do we start to see the end of the summer leading into the the fall months. And then when we look abroad, we're seeing a lot of weakness continue to come through Asia, and that's resulting in some slowdowns in crude imports, as we'll talk about with India. With so far, July imports are well below where they were in May and June. That should reverse a bit in August. But again, we're still just not seeing this absorption of this crude, as U.S. exports still remain very low, even a little bit lower than what we were expecting. We're expecting something closer to about 2.6, 2.8, closer to 2.8 at this point. But these are some of those shifts where there's a lot of lumpiness, and there's just not a lot of confirmation that we're going to really be able to work through a lot of this product before we bleed into the seasonal shoulder season. So let's just look at this in just different pieces now that we kind of provided that summary, and let's be fair, when you look at these numbers, there's really not much to say that there's going to be a breakout or even really a breakdown. It's just, again, kind of prolonging what, on the bullish side, people are saying where, we're going to have rampant demand, there's pent-up demand, there's all this, and it's just not really feeding into the system. And then on the bearish side, you look and there's a weak physical market, there's a weak physical price, but then spreads still remain strong. So there's a lot of this uncertainty, if you will, on who's going to win out and how is that going to shake out, which is why when you look at just where crude prices are, essentially it's been at about 70.50 to about 72.25 over the last week or so. So again, just kind of, I think, biding its time for some real directional move. So then when we turn to oil inventory, excluding the SPR, just because SPR has essentially taken a pause in terms of some of those sales, you can see that we're just right at the point of 2019. And if you remember, one of the things that we were saying over the last few weeks is that we were still going to get draws. They were just going to be much slower. The pace was going to calm down and really start to level off, and that's what we've seen here. Small build last week of about 2 million barrels. Now you have a draw of 4. And again, it's just going to be, imports remain elevated. They're going to continue to remain elevated, and exports are going to remain sluggish as we continue to get production at about 11.5 million barrels a day. So this is just going to keep us, again, going sideways, still with a little bit of draws left coming into the end of August. So we're still expecting to follow this trend where when you look at 2019, which is this yellow line, we started to see a little bit of a build. That's possible, but it's not something that we expect, just given, imports still remain well off of normal pace if you compare it to 2019, even though right now we're starting to see some of that slowdown on the refining side, which is something that we're going to talk about in a minute. So when we look at crude oil supply, for, days of supply for crude oil, you can see it started to tick back up. And the reason why that happened is even though there was a draw of crude, there was also a reduction of refinery utilization rates. So you have to think about this in the same context because they're going to match each other in terms of what oil is there and what is the call on from refiners. So you can see, right now on days of supply for crude oil, we're at the 4th highest ever when you look at where we were in 2017, 2016, and then obviously 2020. So there's, and everything is always going to be spoken about on a seasonal level because you can't compare July to April. They're just not the same. So that's why you could say, well, it's like, well, they were, when you look back, it's like, no, we have to take this in context because when you look at just the normal drawdowns, we typically see these numbers continue to decline on average through the end of August. So this is something where we're starting to see a little bit of a pause. And again, it feeds into what we've been speaking about with a very kind of steady, kind of flatlining situation where we're not really seeing some of the numbers that I think would support on a more bullish front. So then when you look at commercial oil storage and products, putting it all together, we're completely just in line with where we were in 2019. Another thing is, like, again, that pace continues to level off. It's still fairly steady. It's just, and distillate was one of the positive ones this week when you look at what the expectations were. But with jet fuel the way it is, we're expecting to see some of that jet fuel or the spare jet fuel or kerosene start showing up in that distillate pool. And we still expect to see or watch refiners maintain some of that heavier cut that will, again, also yield a bit more of that distillate side, especially when you start thinking about preparation for winter, which is more asphalt, more road repair. So these are things that will also support a heavier cut in the product. Then when you look at gasoline, again, the thing that we've been saying is that we're just going to go sideways. And here's just another one where we're not below the lows that we've seen for 2021. We just continue to go sideways. Again, drifting lower, after some of that essentially a flat number last week, we continue to see this sideways move. It'll continue to move a little bit further down, but just when you consider it for where we are right now, there's only 2 years that were higher, and it was actually 2020 and 2009. So when you think about where we are right now, it's the 3rd highest ever on storage of gasoline. So again, just kind of speaks to where we sit, and we're coming to the end of that driving season. We'll talk about Gas Buddy did a survey, and we have some Google search data to try to iron out, where is that going to go as we go through August and then as we head into September and October. So distillate was the one that continues to drift lower. We're still at the trend is still intact in terms of heading up and having that natural build that we typically get through the middle of September. But again, nothing goes up or down in a straight line, especially EIA numbers, which tend to be lumpy. Some of them are calculated, which is why you really want to look at that trend. And the trend still is holding up, but you're starting to see it kind of level off, which is also going to give room for refiners to take that kerosene, move it into the distillate cut, and also have room to increase some of the heavier imports and try to maximize some of that disti capacity. And then when we look at jet fuel, you can see here that jet kerosene, that it's still seasonally adjusted, one of the highest it's ever been. But as we've been saying on storage, on demand, we just expect this to go sideways. And only because when we look at demand side, you get deliveries, then you get drops, and you keep seeing this movement in general. And then on the storage side, refiners have optionality. If storage is looking elevated, let's just put it over here into this, and see if we can move more into the gasoline side or the octane side, which they really wouldn't at this time because octane still remains elevated as well. So this provides opportunity to put it into the distillate pool. So then when we look at the curve, you can see that over the last month and a half, the curve's essentially been flat in terms of, when you layer it over itself. So there hasn't been too much movement. We're still above 65 through the middle of 2022. So there's still a lot of opportunity for private companies if they wanted to hedge a little bit, if they wanted to, take some, buy some puts. You get an idea of where things are. It's the question is, do you really want to give up some of the upside? As earnings start to come out, you start to see some of the losses, and the way to make up for some of those losses is to produce above them. So it also provides a little bit more impetus to go above those levels. But, hedging can be just a part of the business, because sometimes it works, sometimes it doesn't, and it's hard to try to time it, especially when you're trying to protect yourself. So here, again, you just kind of see where we sit. The curve is fairly firm. We're still above 50 all the way throughout. We've fallen now out of 55 as you get into 2025, but again, this is not predictive. It's just something that you can look at and understand, what the expectations are as we go forward. But, anybody who's been looking at those charts long enough knows that it's far from predictive. It's just more of a guide. So now when we look at COVID cases, we just wanted to touch on some of the case counts, just because obviously they're always making headlines. When we look at Europe, we had the spike. It's starting to come back down. That's on the back of the UK also seeing their case count decline. Again, all net positives. I actually took the UK is this orange one here, so you can see that it peaked, and you're getting some steady movements down. The whole concept is it going to level off? Are we going to start to see this adjust? And then when we look at Asia is where we continue to see this elevated move in cases, with Vietnam hitting a record, Japan hitting another record, South Korea, Malaysia, Thailand. We're seeing this all throughout Asia. And one of the issues that we're having in Asia itself is that the spread of the Delta spread has increased and is well ahead of where vaccinations are. And so far, the UK is a great case study. Spain, something similar, where even though you had the case count go up, you did not see the hospitalizations. You did not see the same type of stress on the infrastructure. So it gives a certain amount of credence and credibility to the vaccinations that have happened for those that have already had COVID, how it's not impacting them due to their body's natural protection against it after getting it. So these are things that we want to see play out again in the U.S., because the U.S. continues to see its own case count go higher, but right now it's not leading to the same stresses. It's not leading. So when you think about government mandates, there's really no need for them. We shouldn't really see too many of them, but people will just take natural precautions. Like, do I want to go here and put myself out there? Do I want to wait a little bit? And that's where we start to see some of those fluctuations in movements. And it's not huge numbers, but again, it's just going to give people a little bit of pause to say, like, maybe I don't need to go out that extra time this week and just try to have some of those avoidance. So this is something we'll keep looking at, and we'll talk about the Asian side and how that continues to show up in the physical market, in crude and product flows through in segment 3. So now when we look at the backdrop of crude stock draws, it was a draw of 4.09 million. The draw was really driven by PAD 5, which had a drop of 3.84 million. And remember, last week there was a big import number, and we said, like, look, that's not going to stick. The PAD 5 has a lot of issues right now on the supply chain, which is making a lot of this very lumpy. And then when you look at the refiners in the region, they've been more actively purchasing gasoline and other products opposed to oil, just because of some of the strong spreads coming out of Asia and some of the opportunity to take down some of that excess. So that's one of the sides. So PAD 1 actually had a build of 340,000. It's still 5 million below the 5-year average, but you kind of get an idea of where some of that stabilization is. PAD 2 had a draw of 450,000. A lot of that was coming from Cushing, which had a draw of 1.27 million, which is now 13.3 million below the 5-year average, and is right in line with that 17-year average that we've seen in that region. PAD 3, on the other hand, had a build of 220,000 barrels a day. 220,000 barrels. Still below the 7.4 million average. 5-year average, but you're starting to see this level off, which is one of the things that we've been talking about as exports drop off due to how expensive WTI is versus other crudes in the world. And you're just starting to see a little bit more of that production increase with some of those imports, which again is just flatlining some of that Gulf drawdown, which as we go forward, that's just going to make comps a little bit easier. So that'll be something to watch. And then crude oil production. Remember, this is a calculated number. So this dropped by 200,000. We don't expect that to remain. There's a lot of things that can work within that. It's going to be downtime in the Gulf of Mexico. It can be some downtime within the U.S. due to weather or other. So that's something that, we still have us closer to about 11.45 to 11.5 million, which is where we have been. And we've been saying that some of these numbers needed to catch up, and they finally did the other week. So then when we look backwards to go forwards, stockpiles rose last week by 6.8 million barrels to come to about 620 million when you look at just land storage. So when we look east of Suez, we're still at the top of the 5-year average. You can just see where we sit in general, obviously well below 2020. But one of the things that we continue to see in the east of Suez is that we're still seeing this elevated number, especially when you think about Japan that is seeing an increase in cases, starting to see some of that slow down. West of Suez started to tick back up, still below the 5-year average, but you can see that the pace of those drawdowns still remains sluggish. And then when you put all of the land storage together, we're right on the money for where we should be for this time of year when you look at the last 5 years. So again, we're not really seeing too much of this drawdown. Now, we had a draw in Europe. We had another draw in the U.S., so that'll move some down, but we're just not seeing that in east of Suez right now. So that's giving us some of this, some of these mixed signals, if you will. And then when you look at the floating storage side, we're still at the high end of storage. When you look at east of Suez, still above that normal cloud. When you look at west of Suez, we're right in line with the 5-year average, and a lot of that has to do with West Africa, just because Europe and the U.S. is well below the 5-year average, and West Africa is well above. So again, that's putting us right at that flatline level. And then when you look at the total in general, you're seeing that we're still well above that 5-year average, obviously not at 2020 levels. But when you look at this all together, you still have a lot of excess in the market that is looking to work through. And as you see the pace of these drawdowns come under pressure, especially when we look at Iraq and their inability to sell that SOMO, which we'll talk about in segment 3, and some of these price discounts that are continuing to roll out in ESPO and other parts of West Africa as they try to compete against that Dubai discount is just, again, making this a little difficult and keeping some of this elevated crude in the market. Now, the other side of the equation is some of the slowdowns in road fuel. This is looking at Europe. So Europe is being impacted by two things: a little bit more of the problems with COVID, again, transitory and actually transitory opposed to what the Fed is saying, where you we'll see some of that come back. But when you look at Europe as an aggregate, you also have a lot of flooding and a lot of rain, and that is also hitting. And I would say that's probably a much bigger driver right now versus COVID. And only because when you look at where COVID really started to spike, it started to roll over before that. And you saw that drop down from June into July, and that was a lot of rain, weather. And then as COVID picked up, you saw that accelerate. Now, China's another one where we continue to see some of these pressures. They have their own, and again, it's small, but they now have some COVID problems, especially the Delta variant, and it goes across about 7 different provinces at this point, which is going to become problematic for them. And then when you look at rest of Asia, again, flat, just based on, as some places get better, some get worse. And then the Americas continue to struggle. Not so much, obviously, the U.S., where we're only about, I would say, 300 to 700. I'd say 500 to 700,000 barrels below normal. But when you look at the Latin America, that's where you continue to see those problems in general. Now, when we look at crude oil inventory for PADD 3, here you can see that it's stopped going down, and now we've had 2 consecutive weeks of builds. And this is where again, just that slowdown in the draws, which is what we've been expecting with the headwinds for exports, the increase in imports, and we expect this to remain fairly flat. We'll probably get a draw next week just because there's going to be some of this catch up. But we continue to see this, again, sideways move playing out. And then when you look at Cushing, that blue line right there, so you can see it's just below the 17-year average. This is one where we keep expecting or keep seeing the some of these slowdowns, but or I should say the pace of draws. But right now it continues to be strong, and that's one of the ones where, as we go into month end, obviously we had the roll. There was a little bit of a pause on the roll, but then things continued right back up. So we're still seeing some of these movements out of storage into the market, and we're not seeing the storage come behind it, even though the spreads do support a move away from the coast into storage. So this is going to be one to watch to see if this is going to come back down, or if we'll start to see this, not so much start to see these big builds, but more level off, which is what we've been expecting, but really have yet to see. So then when we look at imports were down 589,000 barrels a day, 742,000 barrels below the 5-year average. And all of that is driven based on PADD 3, where you can see PADD 3 is still about 1 million barrels below the normal. And the week-over-week change, it was down 275,000 barrels a day. That's the one where it's going to be lumpy, but that's going to remain elevated. And as we were saying last week, we expected to see a decline. It's just we didn't expect it to be a big decline, which is what that really played into. And same with PADD 5. So PADD 5 is the one that's going to remain lumpy. It's still 105,000 barrels above the 5-year average. It was down 192,000 barrels a day this week. This is one where we expect to see a little bit of an increase in imports into PADD 5. PADD 2 was the only one that showed an increase of 56,000 barrels a day. That's going to remain strong, as we've been saying, but that, again, will pare down. So if you think about next week, what should we see? PADD 2 imports fall a bit. PADD 3, PADD 5 imports increase a little bit. And realistically, keeping us in the 6.5, 7.2 million barrel a day range, I think is going to really be what we expect going forward. And then when we look at gasoline imports from Europe, they declined to a 4-week low when you think about the 7 days through essentially the end of last week, while 2 shipments of the fuel, there was a delivery into California. And we'll talk about some of that Asia to U.S. flow, because it's come down, but it's only come down by those 2 cargoes because the rest are still on their way, and there just hasn't been a new order for cargoes so far. But that's going to be one to watch in general. So then when we look at runs were down 131,000 barrels a day. It was down by 30 basis points, back to 91.1%. You had a small increase in an increase in PADD 1 of 101,000 barrels a day. That's going to be supportive if you look at just where some of the draws were on product, especially on the gasoline side. PADD 2 had a drop of 184,000 barrels a day. There was an issue of BP whiting. That's going to be one to watch because we could see some downtime come into PADD 2. PADD 3, fairly flat, down 79,000 barrels a day. Again, that's going to be fairly stable, with PADD 5 only adjusting by 4,000. So these are going to be some of those pieces where we were thinking that there was a chance to get to 93%, but just based on where we are now in the cycle, where gasoline storage is, it doesn't look like there's going to be much of a reason to get to that 93%. So likely we'll stay between a 91 and 92% through the next 2 weeks, and then start to see some of that drop off as we go into seasonal turnarounds. Then when we look at implied demand, so gasoline had a small bump of 30,000 barrels a day to 9.325, about 252,000 below the 5-year. We were expecting a little bit more. The view was that we were going to get closer to about 9.5 on a little bit of a spike back up. So this just means that when we go into next week, because when you look at last week was very strong at about probably a 9.5, 9.6 million barrel a day demand, and this only came in at 9.3. This just means that on this week will come down a bit, but then this will remain at about that 9.3 million barrel a day level, which is really right on the money of where we expect this to be through the end of summer driving. Now, distillate had a big pop of 431,000 barrels a day of new demand, going from 3.9 to about 4.35, which is 531,000 barrels above the 5-year average. Now, remember, this is also going to be that lumpiness. So when we look going forward, we expect gasoline to be right around this 9.3, 9.35. Distillate will come back to about, 4, let's call it 4 million barrels a day. And then jet went from 1.4 to 1.65, which is 23,000 above the 5-year average. And it increased week over week by 247,000 barrels a day. That we expect the full 200 to come down. So we expect to come back to about 1.4 next week. And then when you look at propane, propane came down 162,000 barrels a day to 622. But there's so much exports. Exports were at a record again. There's so much demand because naphtha remains tight in the market, which is just pulling additional LPG into the market. But other oils was up another 367,000 barrels a day. 982 above the 5-year average. And this is where we're seeing some of the strongest, the biggest increases. And other oils is just kind of a catch-all. And this is where you can see these numbers, especially other oils, spike and drop in very, let's just say large degrees in terms of their movements up and down. So that's something that we expect to see some of those adjustments with. And it'll start to move a little bit lower, but again, we'll talk about that in segment 2. So when we look at floating storage, continuing to drift up into the bottom of the cloud, and if you look at just seasonally speaking, you typically get a drop. We expect to see a fairly steady increase. Again, nothing crazy, and then it'll fall within the bottom of the cloud, working its way towards the 5-year average. But remember, it's just going to be a convergence because typically on an average seasonal level, storage comes down, this comes up to meet it. So that's where we're going to see some of that normalcy. PAD 3, saw a little bit of a drop, but again, you're still right within that cloud. We expect to see some of this. Essentially, the highs getting a little bit higher, the lows getting, essentially new higher highs, higher lows, because you're never going to have just straight import increases for 4 weeks in a row. It's going to be up and down. It's just the pace of that is going to be up and to the right. It's just, and that's where we're going to get to kind of a steady level. We're not going to get back to the 5-year average, but again, we're just going to get further within the belly of that cloud. PAD 2 imports still remained elevated. Again, this is something where we expect this to drop back down, but still stay above that 5-year average. It's just, again, there's just going to be some of that lumpiness in terms of where things are coming into PAD 2. Then just kind of rounding it out, looking at normal utilization rates, you can see that we're off the 29-year average in terms of where we typically sit. So this is just going to be something to watch just because, again, we don't expect too much further down. There should be a little bit of a recovery, but we're still going to be off of normal pace just given where storage sits on the product side, where the imports are, how many imports are available, which is going to keep our refiners, fairly capped in terms of where they are. And again, that also helps them try to recover some sort of profit, just given on where some of those crack spreads are. So in segment 2, we're going to go deeper into each specific product and what we think is going to happen over the next few weeks.